Hi everyone, Curtis Edwards here, host of Tea Talk with Curtis, powered by Orion Lending. My special guest today is Victoria Clement from SG Capital Partners. Victoria, welcome to the show. So typically at this part of the podcast, we talk about the mug. So we've got a little Tea Talk with Curtis, if you could see it, but unfortunately you didn't get yours. So you were telling me about the mug that you're using today?
Yes, I'm sorry it doesn't have your name on it, but maybe we can add that.
We can put a sticker on it.
Yeah.
And what's your preference of tea?
I like matcha.
Matcha, okay. I actually haven't tried that. I'm kind of I like to stick with like the Earl Grey, like black tea,
Okay.
heavy caffeinated.
Just,
You know, gives me some energy. It's funny when Jeremy and I started Orion, that's all we used to drink is nothing but tea. And by like 4 o'clock, we were all twitching and all caffeinated up. But it was always a good time. So thank you again for joining. It's always nice to see you. It's been a while since I've seen you in person, but this will have to work. So tell our community about your role within SG Capital Partners.
Sure, and thanks for having me again. I appreciate it very much.
Sure.
I'm a partner and I run business development for SG Capital. I've been here since day one, 2014, when we started the firm.
When in 14? Ours was October 31st of 14.
Oh,
Orion.
okay.
What was yours?
April 2nd.
Oh, okay, you got me.
So good minds think alike, at least in the same year, anyway, right?
We've grown up together a little bit.
Yeah, we have. So anyway, we all used to work together on Wall Street, and several of us came together and said, let's start a non-QM conduit. And we did, back when non-QM wasn't very vogue. Mm-hmm. Of course, now it's going gangbusters and has been for the last couple of years, at least, sans COVID. But, we brought a bunch of good people together out in Stamford, Connecticut, and started the firm. We have about 90 people right now, and we're still privately held. We've all invested in the company, and we buy mortgages, we securitize them, and we hold them, and all that. So it's good.
That's exciting. So let me ask you, if this is more of a preference thing. So do you prefer non-QM or non-agency?
I prefer non-agency. I think non-qualified mortgage is very confusing. Do you agree?
Yeah, I do, and I feel like it almost has a negative connotation to it because when the non-QM products started hitting the market, a few years back, I feel like people thought of it as an outlet for the subprime loans that couldn't get done anywhere else. Right. But that's not what it is. I try to refer to it as non-agency all the time, and sometimes it takes me actually thinking through it. Non-agency, not non-QM, because it almost is like going back to the days prior to the mortgage crash of 2007, 2008, where a lot of wholesalers had non-agency products and didn't actually have agency products that you would go to like your Wells Fargo, your Chase, that sort of thing for. So I've really been trying to push non-agency as well. So when you said non-QM, I was like, I gotta ask the person that knows. So
yes, so let's do that. Let's change that. Maybe
that's it. We're gonna change the nomenclature now. So what have you been up to outside of work? Now that everything's kind of loosened up a little bit, you can fly. I think you still traveled though, even with QM. Even with QM, with COVID and everything, right?
A little bit. I mean, I have to admit, I've enjoyed going to some concerts. Now that they're back, been to the Hollywood Bowl, saw Hamilton, saw Jackson Brown, just some oldies but goodies, really fun. And I am one of these crazy women and men out there who play a ton of pickleball. I play pickleball for like 4 days a week. And,
oh wow, that's exciting. Good workout too.
Yeah, it's a good workout. It's really social, and we started playing a year ago with a bunch of flight attendants who were all furloughed because there was no flying, of course, and then the club has expanded from 100 members to 1,500 members.
Oh wow, where's it at?
It's in Newport Beach.
Newport? Okay. Very good.
Yeah.
Where do you guys play at?
We play right down the street, but we also travel and.
Oh, wow.
You know,
So it's like a hit team or a traveling team for pickleball.
I don't know.
That's awesome. Hey, it's a hobby, you know? It's a hobby.
It's a hobby.
That's
yes.
awesome. Good for you. Good for you. So, what is SG Capital Partners currently doing to support the broker and lender community? I know you guys have a wholesale team as well, right? A wholesale division, and you buy whole loans. So, what are you guys doing to support the broker community?
Well, we basically, broker community, yourself, of course, included, right? So we have products. We've created products that, fill a big need in the marketplace, non-agency, from, first-time home buyers to investors, professional investors, which is what we're doing with you guys, and, serving the self-employed borrower in a very, very big way, as well as just property specific. So,
yeah, that was an interesting article you sent me today, actually.
Yeah, right?
I read through it. It's funny because I've seen some news, feeds coming through my phone talking about how the labor market has decreased as far as wage earners, that sort of thing. And I never actually read through to where they went, and so it's very interesting to see your article and see that a lot of people have switched over to self-employed borrowers, or to be, have their own business, to have more of the freedoms that we all got accustomed to in the last, 2 years.
While many other lenders will only allow for brokers to submit a full broker application in order to get approved, you can get express approved by Orion Lending within hours and no credit pulled. Just imagine, you could be submitting loans with an out-of-this-world lending partner by the end of the day. What are you waiting for? Visit orionlending.com to hyperspeed your business today.
That's right. Yeah. It started, there started to be a big growth in just self-employed in general, and professional investors, DSCR, no ratio stuff, which we'll talk about today. But since the pandemic, it's been a tremendous amount of acceleration in what they call the gig economy, right?
Yeah.
Having a gig. I think a statistic I read this morning, it's about 44% of the mortgage market. The borrowers have some form of self-employment. It could just be a side job, could be their full-time job, or it could be something they're sort of creating, in the process. So it's, growing by leaps and bounds, which is great. It's great for the non-agency business, of course.
Yeah. So with your experience of your products, which product are you finding is helping those borrowers the most?
I think it's split 50-50, sort of hard to say. Our product mix is made up of focus on self-employed, which is about a third of all of our products. Borrowers come in with self-employed, the professional or the first-time investor, which could be a debt service coverage or no ratio, or just the general, basically employed borrower with some kind of issue that the agencies don't want to buy. Could be an IO, it could be a little bit higher DTI, a little bit lower FICO score. So where it's 50-50 in terms of primary and investor, it's about a third made up into those communities. Does that make sense?
Yeah, absolutely. So as you mentioned earlier, we are actually tomorrow, December 1st. If I know when we roll this video, it won't be tomorrow, but December 4th, we're excited to launch a new DSCR no ratio product at the 85% that you've helped us out with. So, prior to COVID and the kind of the demise of the non-agency market, which I'll talk about as well. Prior to that, we worked together on several products. Now we haven't gotten into delivery yet, but what was one of the best things about partnering with Orion then and now?
Well, I think two things. One, you guys are really forward thinking in terms of product development. And we are, because we're privately held, we kind of control our destiny in terms of who we do business with and what we do with the loans, right? So we have fewer customers in total than many of our competitors. And we like it that way because we get to know you. And you and I and the rest of the team, our credit managers, et cetera, we worked really closely on big ideas. And I look forward to doing more of that, this time too. In fact, the 85, that sort of came from you. You're like, we need a little bit higher LTV for a purchase. And so we take it back, we do a lot of R&D, and we say, okay, let's, roll it out. So that's one thing, and I'm looking forward to more of that. The other thing is just the service levels. You and your team have always been straight up with questions and thoughtfulness. If you have a concern, you call us first, and we walk through it and say, we kind of agree with you. Maybe that's not what we want to do. Maybe we could craft it a little differently and, protect us both from, maybe risk, down the road. So I think those are the two biggest things. Also, why we were dormant, I guess, through the pandemic, for that time period, we retooled a lot of our process, put more control in the hands of you guys as a delegated correspondent, and used more technology along the way, which was great too. So those are the things I look forward to working with your team again.
Yeah, this product took a little longer to get rolled out than we had hoped, but there was a lot of programming that I actually did some testing this weekend on it. And the stuff our team does with technology, our business development group, it really is amazing. From the quick pricer, where if you put in a zip code to a state that doesn't allow a prepay, it automatically, it overrides it, it won't let you select it. We make it very conditional based on the guidelines, even on the quick pricer, and then obviously it goes into the pricing engine. Further, we really focused on the scalability of the product, because as we continue to develop our relationship, look at more products, we wanted to make it kind of set the foundation today from a programming standpoint, both in our LOS and in the infamous Star Portal, where we can quickly release new products now. In that the heavy lift has been done going forward. So we are excited about that. We've always focused on technology. The Star Portal is something that we've been working on now for 7 years. It started as a way simply to lock the loan. Now it's developed into a full-blown tool for the brokers to use that allow dual AUS, direct integration with MI companies, closing court brokers to do their own disclosures, Star Marketing Portal. I can go on and on and on about some of the things we've done there. One of the coolest things I think we've done that, as I talk to AEs in the market that are moving around right now, is the ability for third-party processors to work with us with multiple brokers using one login. And as simple as that sounds, that's something that plagues wholesalers, because third-party processors are very prevalent right now. They may process for 3-4 brokers, and unfortunately, it requires a unique login. And they have one email address. So they have to create multiple email addresses and shuffle between them. We've come up with a solution that solves for that, where a third-party processor can have one email address and then can log into multiple brokers and upload loans. So it's little things like that that we listen to both our AEs and our customers on a tech standpoint, and make sure that the user experience is one that's positive.
Brokers, did you know that the Orion Lending team is committed to you and your mission for purchases? Orion provides enhanced turn times for FHA, VA, USDA, and Chenoa down payment assistance purchases, all of which are at 24 hours. Orion offers a diverse portfolio of loan programs to meet your business needs. To take a look at their entire product suite, visit www.orionlending.com/products.
So first-time homebuyers, right? Now is, I don't know if you saw the NBA's expectations for 2022. They're expecting purchases to go up, refis to decline. I think the number was like 62% or something like that. Fortunately, year to date, we're about 70% purchase. So we've done a good job there. We've really seen ourselves as a purchase lender for the last couple of years, in that we rolled out a purchase commitment and those types of things, various products, DPAs, DSCRs, no ratios, to help buyers purchase homes. What are you guys doing for first-time home buyers, millennials, to make the American dream of homeownership possible?
Well, I think one of the best things is this product that you've just rolled out, right? The Investor Connect product, or whatever you're calling it. I'm sure you have some fancy name for it, but so back to 38% of millennials are in some form of like gig economy, but the DSCR product is the simplest product to use, right? It's basically based on the property and the rents. or no ratio, right? If it's just LTV, it's within, or there it's focused on the property, especially in California, places where prices are quite high. But it allows a millennial, or anyone for that matter, could be a senior citizen, to get into the rental market for the very first time with a very simple process to underwrite and lower value. For example, millennials, maybe they can't quite afford a home, a primary residence, but they can buy a rental property somewhere and start getting into building that, home ownership through investments. And we like those kind of borrowers because, like I said, we're focused on the property itself. The rents may be used or may not be used depending on the product path that you choose. And it allows millennials and first-time home buyers just to get into that income growth outside of equities or stock markets or other things, or their just general income. So it's sort of a feature and building a little portfolio, which is great.
So on the topic of not only the DSCR no ratio, but really all the non-agency stuff that you do, how are specifically, this question is specifically geared towards the no ratio DSCR, and this may put you in the spot, so I apologize. What are you seeing as prepaid speeds on this?
Well, the DSCR stuff, the investor product does come with a prepay, right? So when you're prepay to, to 5 years, depending on, what you want to, pay for or the borrower is willing to pay for. So speeds are low, right? People see this as more of a long-term hold rather than a fix and flip. That's a whole nother product, right? But that product is a good product, and it does exist out there in the marketplace, of course. And it's a product that we're looking into right now. But speeds are not high. In general, rates are low. The spread between agency and non-agency has shrunk, right? Much different than when you and I did business, over a year ago, right? They seemed quite high, at least in appearance at the time. So people are hanging on to this stuff a little bit longer.
That's one thing I was going to mention too, is historically the rates on the non-agency stuff, it's still low. I mean, you're still getting a great rate. I mean, you're in the 4s in most cases.
Right.
So it's hard to argue with that. How about the overall loan performance?
Loan performance is good. It actually was still even quite good through the pandemic. There's something to be said for, and let's talk about general non-agency stuff. Underwriting a borrower using their bank statements versus their tax returns. If you look at a bank statement, we've had this conversation before. A bank statement really tells you how someone lives. The cash flow in and out of their life, their savings, what they spend money on, versus a tax return, which is static and not always an accurate reflection of the picture of the borrower and the ability to repay.
Yeah, it's also gross income. It's also gross income, right? Which we all know how that works out.
Yeah, there was never really a problem or an issue with the performance on these loans, especially the core part of the business. So we've continued to want to stay in the space. I mean, $25 billion next year is a lot of business to be had in non-agency world. So
I will take my chunk of that.
Yes, as would be.
Very cool. So kind of going back to the pandemic and kind of what happened in March of 2020, right? It was bonkers. In your opinion, what happened in the market that caused the non-agency stuff to kind of just instantly pull back?
Well, it really was one of just panic and assurances. No assurances, I guess is the better way to say it, in terms of what the takeout would look like. The government supported Fannie and Freddie, of course, through the process, but the private market was sort of left to its own, demise or, pause, as we called it at the time. And unfortunately, there was not a bid for the mortgages. The warehouse banks got a little nervous too, and it wasn't anything to do with the product. It wasn't like the product was, performing poorly. It was, this pandemic that no one knew what was going to happen.
Yeah, that's what's crazy about that to me. Is when you look at performance of FHA loans, VA loans, conventional loans, obviously conventional perform better, but FHA, DPAs, those loans are generally higher risk than even non-agency loan. So it's interesting to hear that the market reacted that way. Now, Do you feel that there's some potential for that to happen again in the future with another unknown event? Or do you feel like the market would react, seeing that it's come back so quick, that maybe people will pause a little bit before you're having that knee-jerk reaction?
Well, I think people have seen how fast it has come back, right? And I think that's given assurances all around, the banks, the execution, the securitization market, the rating agencies, et cetera. And so that should help. Never say never in this business. I just don't know what the next one's going to look like. The hard part about this particular issue was it wasn't really explainable, like you just said. It wasn't like the '08 crisis where you had, HPA and other issues, teaser rates, et cetera, all coming to play. Lower credit scores and the underwriting standards, a lot of factors, right? And you can actually explain that and why it happened. This is really difficult to even grasp sometimes, but we're happy it's over. And it gave us, like I said, time to just pause and rethink our process and give you guys a better experience, when we rolled it out again. So.
Yeah, well, we're jumping in the deep end, so we're going all in on this. We love the product, and like you said, it does perform well, and there's so many borrowers out there that need good lending opportunities and options. So we're all in on that. I appreciate your time. So I got one more question for you. So being on the front lines with Wall Street and all of your traders and everything like that, what can you share? Any new and exciting products that you guys are developing right now? High level, maybe?
We never want to give away our secrets too soon.
Anything cool?
Live television, live YouTube, whatever it is.
Right.
We are working on a 5 to 8 unit offering. As you know, 1 to 4s are covered, and we've got that set up. So we do find that there's a niche right in between those two areas. We're also looking at maybe a little bit higher LTVs on some of the pieces of stuff you rolled out, and then just adding more technology. Hybrid appraisals, CU scores, all that kind of stuff. Emulating what's already out there and working well in the space, and then possibly, like today, raising even the maximum loan amounts. So those are some of the things on the plate. And I'm sure, Curtis, you're going to add probably 4 or 5 more to that list, right?
I've already wrote those down, so I'll be helping you expand on those. I've got a few ideas. So I'll touch base with you, and we'll discuss those. No, I love the partnership. I love the forward thinking by you and your group. I love you being open to hearing feedback from us, because look, our feedback is ultimately coming from our account executives who are out in the field in front of these brokers, and the brokers are telling the agents what they need and what they want to be successful. It gets filtered back to us. I bring it to you, and we do something with it. So that's the type of partnership that we like. We don't partner with a lot of investors, a lot of aggregates. We like to keep our relationships very deep, keep them close, and really work closely with the people so that we have those great relationships and we're successful together for long term. So again, thank you so much for joining me today on Tea Talk, and we'll talk again real soon.
Yeah, and thanks again for the partnership as well. Appreciate it very much. Take care.